Hey everybody, and welcome to our third video on the determinants of interest rates. And today we're going to talk about specifically two market-wide effects on interest rates. First, recessions, and second, inflation. But just as a reminder, this should be familiar to you from your principles courses, but the business cycle in economics is a stylized fact about how a capitalistic economy is going to go through large periods of rapid expansion, and then after it hits some peak, it's going to go through a rapid contraction. So this is, like I said, very stylized. There's not a lot of mathematical foundations to predict when recessions will happen, but we do see this in the graph at the bottom, which is the United States' real GDP since 1995. We can see three clear effects to the general trend in the GDP, real GDP of the United States, and they all are associated with recessions. The first one is the dot-com bubble bursting, and then the second two are the ones that we've been talking about throughout the course, the Great Recession, and finally the COVID recession. So how do interest rates get affected and changed during recessions? Well, on the top graph, we see that they are changed in two ways. Using the supply and demand graphs that we talked about in the last video, we can see a recession is going to have a dual effect, one on the household side or the demand side, and then one on the company side or the supply side. When there's a recession, two things happen. First, household wealth is going to fall. Second, the expected profitability from these companies starts to fall. And when that happens, it's going to shift both the demand curve and the supply curve to the left. And that means that when we want to look at the market for corporate bonds, it's usually pretty actually ambiguous what the effect is going to be on the bond yields. So in the bottom, I've graphed out since 2000 the Moody's season BAA corporate bond yields, and just as a little bit of a side, BAA means that we're not looking at the highest rated bonds, but rather we're looking at some mediocre meh bonds. When we look at these three same recessions, dot-com, Great Recession, and COVID, we can see that in the first one, bond yields were actually really flat. And what we can take from that is that the household effect and the supply side effect pretty much canceled each other out. However, in the Great Recession, there was a huge surge in bond yields. And so what that means is that because the profitability just plummeted for these corporations that were issuing the bonds, the supply side effect was way more significant than the demand side effect. And there are several possible reasons for this. The first is that it could be just that the people that are investing in corporate bonds are not the ones that were getting laid off, and so their wealth didn't really change too much. A second possible one is that while we're just talking about US household failings, a lot of these companies that issue corporate coupon bonds are multinational and global, so they were way more exposed to a worldwide recession than a lot of these individual household investors. So they saw a way bigger shift to the left than the households did. And then, regardless of that explanation, almost the opposite seems to be true during the COVID pandemic. You can see that bond yields actually dropped significantly during COVID, down to about 3% for these medium level bonds when they reached nearly 10% during the Great Recession. And one of the big reasons for this happening is because of the bailouts that we talked about from the Fed and US government. The Fed and US government did a great job of stimulating economic activity in these corporations, and there was not a lot of pessimism in the market for the long-term recovery ability for a lot of these companies. You know, there wasn't a lot of worry that like Ford wouldn't be able to recover once we got through COVID. However, on the flip side, the savings rate in the United States, as we mentioned, skyrocketed during the COVID pandemic. And wealth fell significantly because a lot of people got laid off. And so there was a huge demand side effect, while not a very large supply side effect. And that dropped corporate bond yields significantly. Next, let's talk about inflation. And there is one big term that we need to take away from this slide, which is the Fisher effect, which basically says that nominal interest rates rise or fall point for point with changes in the expected inflation rate. And so what does that say? That basically says that when inflation increases 1%, then nominal interest rates are going to rise 1%. And the reason for this is that there should be a linear relationship in, as we can see in figure 4.7. So as we talked about in the last video, companies get quite excited about inflation because it means that the real coupon rate drops. And so they want to issue more bonds. So that's going to shift the supply curve to the left. However, investors do not like it, and so they're going to shift their demand to the left. And that's going to have a net effect of there's going to be no change of quantity of bonds in the market, but there's going to be a drop in the price of bonds. And that relationship stylized is roughly the same percent drop in the interest rate as with what the inflation rate was. But since we're talking about real interest rates versus nominal, since it's a point for point change, the real interest rate should be unchanged. So this is an important distinction between nominal and real. The real interest rate, according to this, will not change when we see a linear growth in inflation. So that's it with chapter 3 or this third video. Move on to the last one, and then you're done with this unit.